Hi, I am from Kangaroo Energy. Gold prices are hitting record highs, headlines are everywhere, and suddenly everyone is asking the same question. Should I buy gold now, or have I already missed the boat? Some people believe gold is the safest place to be when the world feels unstable. Others think buying gold at all-time highs is a classic mistake. In this video, I'm going to cut through the noise and help you understand whether gold still makes sense today, and more importantly, who it actually makes sense for. Let's start with why gold is rising in the first place. Gold usually climbs when confidence drops. When people are worried about inflation, interest rates, currency weakness, or global uncertainty, they look for something that feels stable. Gold doesn't rely on a government, a company, or a central bank. That perception alone pushes demand higher when fear increases. But here's the first mistake people make. They assume that because gold is going up, it must keep going up. Gold is not a growth asset. It doesn't produce income. It doesn't compound. It doesn't innovate. Gold protects value over long periods, but it doesn't build wealth the way businesses, property, or productive assets do. That distinction matters a lot, especially when prices are already high. Historically, gold performs best when real returns elsewhere are weak. When cash loses purchasing power, when markets feel fragile, and when people want insurance rather than upside. That's why gold often rallies late in economic cycles, not early ones. Now let's address the big question everyone avoids. Is buying gold at record prices risky? Yes. Buying any asset after a sharp run-up increases risk. When prices rise quickly, expectations rise with them. That doesn't mean gold will crash, but it does mean future returns are likely to be lower than people expect. Gold doesn't collapse often, but it can move sideways for years. If you buy gold expecting fast gains, you're probably buying it for the wrong reason. This brings us to the real role of gold. Gold is not a bet. It's a hedge. In a diversified portfolio, gold acts like a stabilizer. It can reduce volatility and protect purchasing power during stress periods. But once gold becomes the main focus, it stops being protection and starts becoming speculation. For most Australians, gold makes sense only as a small allocation, not a replacement for everything else. Think of it as insurance you hope you don't need, not a lottery ticket you expect to win. Another common misunderstanding is thinking gold always beats inflation. Over very long periods, gold tends to hold value, but there are long stretches where it underperforms inflation, especially when economic growth is strong. Gold shines during fear, not during prosperity. So who should actually consider gold right now? Gold may make sense if you're worried about currency risk, long-term purchasing power, or portfolio volatility. It may also make sense if you already have diversified investments and want balance rather than higher returns. Gold probably doesn't make sense if you're chasing growth, trying to time the market, or reacting emotionally to headlines. And this part is critical. The worst time to buy gold is when fear makes the decision for you. Smart investors decide their allocation before panic hits, not after prices have already surged. If gold wasn't part of your plan before the headlines, adding a large position now should be approached carefully. So is gold still a smart investment? It can be, but only if you understand what it does and what it doesn't do. Gold protects. It doesn't multiply. Gold stabilizes. It doesn't compound. Gold is a seatbelt, not an engine. If you treat it that way, it can play a useful role. If you expect it to make you rich, it will probably disappoint you. The smartest move isn't asking whether gold will go higher. The smarter question is whether gold belongs in your plan at all. Subscribe for more videos, like, share, and stay informed.